Okay, just wanted to run a short video on the month of April and the chart of the S&P 500 and just see how April went in terms of economic news and sort of factors affecting the market. Okay, so the month of April. We'll start off with floor talk. Markets struggle to gain direction in April as QE debate intensifies. So we're talking about quantitative easing, and if the Fed increases quantitative easing, therefore they print more dollars, that increases or has a buoyant effect on the market and a decreasing effect or bearish effect on the dollar. So in April we saw the S&P head lower by 0.7%, and you can see that. So the result of April was that the S&P dropped from a high of 1422 and ended up at 397. So a drop of just below 1%. Although it was a flat month overall, as far as performance, there were many events that impacted trading this month. The first significant event occurred on April the 3rd with the release of the highly anticipated FOMC minutes. The minutes contained a more hawkish tone than some may have anticipated, with members suggesting the timing of the removal of existing accommodative policy could be reversed if warranted. Although it seemed like a rational position to take given the improved economic data, the markets responded in an anti-QE fashion, with a weakness in the asset classes that benefited from QE, gold, equities, bonds, and the strength in the dollar, which is weakened by QE, should benefit from improved economic conditions. The market closed lower by just over 1% the next day. The ECB kept rates unchanged at 1% as expected. Draghi said he's not talking up his rhetoric on inflation. The ECB again left rates unchanged today. Okay, so that had a bearish effect on the markets. The markets could see that they weren't going to get any more QE, not at the moment anyway, and therefore the markets sold off slightly. Okay, carrying on in April. On the 6th of April, the markets were closed for Good Friday, but we did get a good look at the March non-farm payrolls report. As we noted, non-farm payrolls added 120,000 jobs in March, down from adding 24,000 jobs in February, and well below the Briefing.com consensus expectation of 200,000 new jobs. The report was nothing short of disappointing. The following Monday, the US markets got their first chance to react to the data, and the S&P closed down 1.1%. Okay, so the Friday was the non-farm payrolls report, and it came in at 120,000. Markets were expecting over 200,000, and the market sold off on the Monday, the first chance they had an opportunity to respond to that, and sold off for the following Tuesday as well. Came all the way down to a support level at 1357, which we'll mark in. Okay, so the reason we're doing this, and the reason it's important to keep a check on what the overall conditions of the market are, and very high impact news related trading impacts, is that if you know what the sentiment in the market is on that particular day due to certain news or due to certain conditions in the market, you're obviously going to favor overall a certain type of trading. So if we knew that the non-farm payrolls came in at 120,000 and the market was expecting 200,000, obviously a really bad and disappointing figure, that day we would obviously be favoring shorts. We wouldn't be favoring longs because the whole market sentiment is short. And that's a really, really important point. You would only trade shorts that day, not trade any longs. Okay, going back to the report. On April the 15th, we got some disappointing news from across the pond after Moody's announced ratings reviews affecting 114 European financial institutions in 16 European countries. On the 16th, the People's Bank of China widened its trading band for the yuan, which is the first such move since May of 2007. The yuan subsequently moved to a 3-month low versus the dollar amid increased worries over Europe. Okay, so you can see the impact of that news announcement. Over here, we had a big red candle day, and the market sold off from the 1388 area, and ended the day on 1370. So, a 18-point move on the S&P, which is quite a reasonably large move for the S&P. Okay, so here we can see that the market got additional information that there's a possibility of further Fed easing, which means more printing of dollars. Therefore, the market rallied, and here we can see a very big day for the S&P. Rallied from 1372 all the way to 1390, another 18 point move in the S&P. Quite a nice move. In corporate news, earnings season has gotten underway, and through April the 30th, 305 of the S&P 500 constituents have reported quarterly results. That's over 61%. So far, 72% have beat earnings expectations and 20% have missed. While this marks an improvement from just under 60% at roughly the same juncture in quarter 4 of 11, earnings season and the historic average in the mid 60% range, it is in line with the 72% rate at roughly the same juncture in the first quarter of 2011. In terms of notable reports, Apple shares jumped just over 9% following a blowout quarter, while Amazon showed double-digit gains in its shares after beating on the top and the bottom line and guiding quarter 2 revenues in line. JP Morgan posted a solid quarter, however its shares sold off 3% as investors took profits following the run-up in shares into the earnings release. Okay, so we're just looking at Apple, and as you can see, Apple gaps up 9%, which is quite an incredible gap up. That is over, let's see, gapped up from a close of 561 and gapped up to 609. So quite a hefty gap up. Amazon, after reporting, also gapped up from 196 to 226, so a gap of nearly $30. Huge gap up. That's a daily chart. Let's take a look at the weekly chart. So Amazon is really doing well. Their charts really increased.